Blake Bos here, folks. Today we're going to be talking about shipping and how in today's marketplace it might require a lot of luck and trading skill to be successful in investing in this sector. So we have shares up a lot here recently. The Capital Link Dry Bulk Shipping Index tracks a variety of dry bulk shipping companies, up 35% year to date. Dry Ships, which is also included in that index, is up 100%. So as you can see, some big moves. You also have media pundits like Jim Cramer touting shares of Dry Ships and Diana Shipping on his show. You also have a few analysts giving the sector a thumbs up. But then there's a big disconnect between industry insiders and what you're seeing on mainstream Wall Street. It makes you think you're missing out on something big when you see shares rallying this much and you have so many media pundits touting those shares. So Wall Street sees the rebounding shipping rates here recently and thinks a rate rally is imminent, but aren't looking at things from a long-term perspective. We need to look a little deeper. Typically a rally at this time of the year is normal. Iron ore demand from China has been well, and you also have a strong grain season leading to a temporary rebound in rates, but those typically fall off going into January of 2014, and China is still a huge risk if their economy were to experience a shock, which many economists and media pundits alike believe is on the horizon. So as you can see here, there's a lot of uncertainty around how sustainable rates are. And we look to Benjamin Nolan. He's a shipping research analyst at Stifel. He's really knowledgeable on the subject. He said rates are slightly better than last year, a few $1,000s a day at best, but still barely above operating break-even levels for these companies. The market's still extremely oversupplied and rates are really poor. Basically, there's just too many boats in the water. So as you can see, Benjamin Nolan, lots of caution here saying, really be aware of this market. Takeaway here, folks, is dry bulk is one of the risky areas to invest your money today, and Dry Ships takes the prize as a risk leader in my book. They have $941 million of credit associated with the shipping portion of their business, and as of last quarter, they weren't generating any cash or earnings from that business. And remember, they can't use their stake in Ocean Rig for operations in their vessel business. At the end of the day, they have to start using that $1.4 billion Ocean Rig stake or issue equity to satisfy debt holders and maintain operations in the long term if rates stay where they are today. Dry Ships can't use any of those operations, like I said, for its ships, and recent gains in this sector aren't based on any company fundamentals. It's a trader's game right now, folks, and it requires a lot of luck. You got to exit while things are good. Basically, it's not a long-term investor's game to play. That's all I have to say, folks. Thanks for watching, and Fool on.